Hi, this is Kelly Wright at the Money Show in Philadelphia. Joining me is Marvin Appel with signalert.com, also the editor of Systems and Forecasts. So you have a service that this gentleman has forgotten more about technical analysis than most people have known. Let's just get that out on the table, okay? So in your service, Systems and Forecasts, you make that available.
Yes.
But then there are people who don't have the time, they don't have the inclination, they don't have the confidence, they don't want to do this stuff themselves. So this is where you step in and you'll manage their money for them.
Absolutely. In fact, that is the bulk of our professional activity, is exercising investment discretions on clients' accounts, using technical analysis to profit for the clients when times are good, and to protect them from the worst of the major market declines when times aren't good, which happens from time to time.
So how are you structuring portfolios right now?
Okay.
Just generically, you don't have to give away the farm,
right.
But okay.
No, it's a good question. Again, it depends on the client, but in general, it's interesting if you're looking at historical risk-adjusted returns,
right?
So balance between return and risk. One-third, two-thirds, roughly speaking, is a good mix. So if you're on the more aggressive side, it's two-thirds stocks, one-third bond strategies.
Okay.
And if you're on the more conservative side, one-third stocks, two-thirds to bond strategies.
Okay.
So that's how we manage it, of course, with the exact mix being depending on the client. The bond strategies emphasize high-yield corporate bond fund trading, some corporate floating rate bond fund trading, and for tax-sensitive clients, high-yield municipal bond fund trading.
Are there still high yields in the muni market?
Well, it's relative, but federally tax-free, you can get 3 maybe to 4%. And
in this environment, that's actually pretty good.
It is.
Wow, and it's tax-free.
Yeah, and the nice thing about high-yield municipal bonds is they behave in this environment ever since the end of the financial crisis. They behave much more like investment-grade bond funds. So they diversify the corporate high yields. So when there's a recession fear and Treasury yields drop, long-term Treasury yields drop, the corporate high yield bond funds also soften, but the high-yield munis behave more in parallel with the Treasuries. Again, there's no law of physics that says that's always going to be the case, but that's what's been going on for most of the last 10 years. So it's a good portfolio diversifier.
So I would take that as that states and municipalities have kind of gotten their act together.
It certainly seems that way, yes.
Because where I live in Orange County, years and years and years ago, I'm dipping back into history, but actually history is littered with cases of some states and municipalities doing some pretty dumb things. So
it is, and listen, some of the riskier high-yield muni funds where they're heavily exposed to Illinois or Puerto Rico, their funds are reflecting that, but most of them have kind of taken a safer tack, and so they haven't evidenced any kind of default risk fear, even during those times. For example, the fourth quarter of last year, when the rest of the bond market was fearing recession, the high yield munis held up relatively well.
That's actually good news, because I think you have to have a strongly functioning state and municipal credit market, because otherwise everyone's piling into the same assets and the boat starts to list on one side. Let me switch gears with you just have a second, because I'm just curious. Have you noticed in the era of, or technically I guess post-QE, but how did that era of quantitative easing, extraordinary measures by the central banks, what did that do to technical analysis? I mean, did stuff still work the way it used to?
Basically, no. I mean, not as well in many cases.
Okay.
I think the Federal Reserve has suppressed normal market volatility.
I agree 1,000%.
And that and electronic trading. So moves that used to unfold over a period of weeks now unfold over a period of days. So it is a different game, and I think the name of the game is, I mean, the core of technical analysis, at least as we practice it, intermediate term, weeks to months of holding, is to identify the major trend, figure out what your risk budget is, so that tells you how much to allocate to moving with that trend or attempting to move with that trend. And then you have to ride down a lot of stuff that 20 years ago you could have short-term traded in and out of, but now you can't. It just doesn't work as well. The correlation from one day to the next is much lower now than it was in the 90s and before.
High frequency trading, is it here to stay?
I would believe so.
Yeah. Okay.
I mean, I don't practice it, and it's from my point of view, it's a double-edged sword. On the one hand, it improves ETF liquidity. I mean, when you
okay.
you know, when you think about when iShares first came out, if you wanted to buy like the large cap value ETF, IVE or IWD or something like that, there was a 25 point basis point bid-ask spread. Crazy.
Yeah.
Now they're a penny wide.
Yeah.
And I think that's thanks to the high frequency traders. So that's the good side. The bad side is that again, you can have these eruptions of short-term volatility. I mean, the flash crash of in 2010 was a big example of it, but other things happen. So I think the net effect of that is that, at least as we're managing clients' money, is we're reducing our equity allocations because there's short-term volatility that is harder to control with technical analysis, harder to manage, and increasing their allocation to corporate high-yield bond funds, where, at least in the open-end mutual fund space, there's still a lot more price stability and a decent return. I think high-yield bond returns are very attractive risk versus reward compared to equity returns, with especially because there's a lot less volatility going forward. It's certainly been true over the last 20 years.
You know, I could talk this stuff with you all day long, but we're going to have to wrap it up because that's the way media works. With Marvin Appel, this is Kelly Wright at the Money Show in Philadelphia.